So far in this series, we've learned what a normal distribution is, and we've seen why financial markets don't actually follow it. But that raises a question. If markets aren't perfectly normal, how do we describe the ways they're different? That's where two important statistical measures come in: skewness and kurtosis. Don't let the name scare you. By the end of the video, they'll make perfect sense. Let's start with skewness. Imagine the normal distribution again. It's perfectly symmetrical. The left side is a mirror image of the right side. Skewness tells us whether that symmetricity still exists. If a distribution is positively skewed, the right tail is no longer than the left. That means there's a greater chance of very large positive returns. If it's negatively skewed, the left tail is longer. That means extreme negative returns are more likely. In finance, negative skewness is something investors pay close attention to. Why? Because it suggests that while returns might look fairly normal most of the time, there's a greater chance of experiencing a really bad day than a really good one. It's one of the reasons why some investments can appear stable for months or even years, only to suffer a sudden significant loss. Think about two games. In the first game, every outcome is pretty balanced. You win a little, lose a little, and occasionally break even. In the second game, you win small amounts almost every time. Sounds great. Until one day you lose everything you've won in a single round. Both games might have the same average return, but the second one has much more negative skewness. That's why average returns never tell the whole story. You always need to understand the shape of the distribution as well. Now let's talk about kurtosis. Kurtosis measures how much probability sits in the tails of a distribution. Remember our discussion about fat tails in the previous video? Well, kurtosis is one way of measuring exactly that. A normal distribution has what's called normal kurtosis. A distribution with high kurtosis has much fatter tails. That means extreme events happen more often than you'd expect under a normal distribution. Here's something people often get wrong. Kurtosis isn't really about how tall the peak of the distribution is. It's about how much weight is sitting out in those extreme outcomes. The higher the kurtosis, the greater the likelihood of unusually large gains or losses. These two measures tell us things that volatility alone can't. Volatility tells us how spread out returns are. Skewness, on the other hand, tells us whether risk is biased more towards gains or losses. Kurtosis tells us whether extreme events are more common than we normally expect. Two investments can have exactly the same average return. They can even have the same volatility. But if one has much more negative skewness or much higher kurtosis, it's usually carrying a very different type of risk. That's why professional quants don't just stop at just looking at averages and standard deviations. They want to understand the entire shape of the return distribution. So here's the key takeaway. A normal distribution is described by its mean and standard deviation. Real financial markets often need two extra pieces of information: skewness and kurtosis. These statistics help explain why markets don't behave as neatly as the bell curve suggests. In the next video, we're going to focus on one of the most important ideas in modern risk management: tail risk. We'll look at why investors spend so much time worrying about events that are supposedly to be incredibly rare, and why those events often matter more than everything else combined. If you're enjoying this series, make sure you're following the Money Loop as we continue building your quantitative finance toolkit from the ground up. Thanks for watching, and I'll see you in the next one.